All right, so back at it. Exclusion provisions. We'll go through this briefly because we've already talked about it. But why do they do this? Well, they're subsidizing or encouraging particular activities. In the case of municipal interests, they're trying to get um taxpayers to invest in these municipal bonds, state and local governments, so that people, they're trying to get them to support state and local governments through these bond sales. Gains on the sale of personal residence. We'll talk about this in chapter 14. But as a general rule, taxpayers can exclude up to $250,000, and for married filing jointly, $500,000 of gain on the sale of their principal residence. You have to satisfy both the ownership and the user use tests. And if the amount of the sale after deducting sales expenses as well as the basis of the principal residence, if that gain occurs, then the excess qualifies as a long-term capital gain. Well, what happens if you have a loss on the sale of personal residence? Well, tough luck. You can't use any of that as a capital loss because it's a personal use asset. Fringe benefits. We'll talk about this in chapter 12, but just realize that most employers provide some form of fringe benefits. You know, they can be something as silly as free coffee at work, or it can be, things like health insurance, or excuse me, health club memberships and things like that, or parking benefits. And so fringe benefits that uh, are listed as qualifying fringe benefits are excluded from gross income. So medical and dental health insurance coverage, life insurance coverage, and other what they call de minimis benefits are qualifying fringe benefits. And so here's a list of those, but again, we'll talk more about those in chapter 12. All right, so what about benefits for education? Again, the Congress is trying to encourage certain behavior. Certainly, they want to encourage higher education, don't they? And so, because of that, they exclude certain types of income if the funds are used for higher education. Scholarships. If you're seeking a college degree, which I believe almost everyone listening to this is, and you receive a scholarship in seeking the college degree, you can exclude the scholarship amount as long as it pays only for tuition, fees, books, and supplies. So, for instance, if it were to pay for housing or meals, that portion of it would be included in the taxpayer's income. Now, this exclusion applies only if the recipient of the scholarship is not required to perform services in exchange for receiving the scholarship. So, for instance, if you are on a work study scholarship, that looks like income in trade for services, right? So that's going to be taxable income. Now, there is a limited exception to that for tuition waivers given to student employees and what they call teaching and research assistants, graduate assistants. Oh, back on this. Also, whoa, what if you're an athlete? Same rule applies for an athlete. Excuse me. Now, used to, if you were an athlete, um, if you got an athletic scholarship, it you did not have to include that scholarship in gross income to the extent that it paid for tuition fees, book supplies, and other equipment, as well as um, room and board. But apparently that's changed. Any excess amount for room and board is taxable to athletes. And of course, there's the IRS has ruled that the value of those scholarships is excludable from gross income, again, to the extent it pays for tuition fees, books, everything but room and board. But it's excludable only if the scholarships awarded to students by the university that expects but does not require the student to participate in a particular sport, requires no particular activity in lieu of participation, and also is not canceled. The scholarship's not canceled if the student cannot participate. They mentioned some other types of educational subsidies, 529 plans, and things like that here as well. All right, moving on to exclusions that mitigate double taxation. All right, so they're trying in some instances to eliminate the potential double tax here. So when you receive a gift, you don't have to report that gift as taxable income. When you receive an inheritance, you don't have to list that inheritance as taxable income. Why? Well, because in the case of a gift, the giver has to file a gift tax return. So it's possibly subject to a gift tax, which is a transfer tax. So it's potentially taxable under the gift tax laws by the giver, not the givee, recipient. What happens if you inherit property? Well, same deal. An estate tax return will have to be filed by the administrator of the estate. And so it's potentially, that transfer of the inheritance is potentially payable by the estate of the decedent, not the recipient of the inheritance. Because if it was, you'd have a double tax effect. Life insurance proceeds. if you're a beneficiary on a life insurance policy and the person covered on the life insurance policy dies, you, the beneficiary, do not have to report the proceeds of that life insurance policy. Why? Well, I guess because the book opines that life insurance proceeds are similar to inheritances and thus should not be subject to federal taxes. As a matter of fact, when the decedent dies, they have to list the face value of the life insurance policy as being a part of their estate in an estate tax return that has to be filed within 6 months after death of the policyholder. Now, there are some exceptions to that, such as when proceeds are paid over time rather than in a lump sum, because when paid over time, the recipient's also not only receiving principal, but they're receiving interest as well. And so to the extent that they're receiving interest, that interest income is income. Okay, so we talked about the fact that gross income includes income from whatever source derived and wherever derived. If you're an American citizen and you're earning income overseas, you still have to report that income. So there's the potential for double taxation there. And there's a couple of ways you can, you the taxpayer can get around this. And so one of those is called the foreign earned income exclusion. The maximum exclusion for 2018 is $103,900 that can be excluded from gross income if you meet the requirements. You can also exclude a maximum of $14,546 of employer-provided housing but only to the extent that the costs exceed $16,624 in 2018. To be eligible for this foreign earned income exclusion and the housing exclusion, the taxpayer must have a tax home in a foreign country and be considered a resident of the foreign country by living in the country for the entire year, calendar year, or live in the foreign country for 330 days in a consecutive 12-month period. So in that second case, you could have 2 tax years overlapping. So here we have an example of that. Courtney is considered a transfer of EWD's overseas affiliate where she will be paid $120,000 annually. Assume that her 12-month qualifying period includes only 200 days in the first year and 140 days in the second year. How much of her expected $65,000 salary in the first year can she exclude? And so you take the full exclusion, 103,900, and multiply that times the 200 days that she's there in the first year into 365 days, total days in the year for 2018. And so she gets to exclude $56,932. All right, moving on. Sickness and injury related exclusions. Workers' compensation benefits. You're hurt on the job and you make a claim for workers' compensation payments. Those payments are non-taxable to you. Now note, if you get laid off and you make a claim for unemployment benefits, those unemployment benefits are taxable to you, but not workers' compensation. Why? I, again, don't know for sure, but I guess in the case of unemployment payments, that's a substitute for your income that you would otherwise earn, except for being unemployed, whereas here you're not working not because you can't work. You were hurt at work. So that's the only reason I can think. Payments associated with a personal injury are excluded to the extent that they are attributable to the physical injury, which includes payments for past, current, and future lost wages, as well as past, current, and future pain and suffering. It also includes any emotional distress that can be tied to the injury as well. Now, if the emotional distress is claimed to be a part of this, but it's not related to the physical injury, then that would be compensated. Let's say you are hurt in an accident and you sue the other party that caused the accident, and you go to trial, and because the other party was so egregious in what they did that they award, the jury awards punitive damages, because they're trying to send a message to this defendant as well as to others who might in the future do egregious things like this defendant. Well, those are punitive damages, and punitive damages are fully taxable to the recipient. Healthcare reimbursement. So, reimbursements by health and accident insurance policies for medical expenses paid by the taxpayer or are excluded from gross income. Well, that kind of makes sense. They're paying it out of their pocket, but then they're getting reimbursed by this policy. Notice that this exclusion applies regardless of whether the taxpayer's employer, or someone else purchased the health and accident policy. So that's a pretty good deal. Disability insurance. This is the AFLAC exclusion. AFLAC is a disability insurance company. So you see those commercials on TV. You know, what do I do? How am I going to pay my bills if I can't work because of injury? Well, that's disability insurance. It's a wage replacement insurance. How disability insurance is taxed depends on who pays it, for the most part. There is an exception here. And so if the wage replacement, the disability insurance policy, is paid for by the taxpayer, then uh, any of the proceeds on a claim for disability are non-taxable to the taxpayer. If the taxpayer's employer pays for it and the taxpayer receives disability benefits, then those benefits are fully taxable to the taxpayer. The one exception to that is if the premium's paid by the employer, but the employer gives the employee the option of treating it as taxable compensation, the premiums paid as taxable compensation to the employee, then in that case, it's still not taxable. But if the employer also gives the option between either being a taxable compensation or non-taxable fringe benefit, if the employee determines that they want to receive this as non-taxable fringe benefits and later makes a claim and receives disability benefits, then in that case, where it's a non-taxable fringe benefit, the taxpayer employee is going to be taxed on those benefits received. Last but not least, deferral provisions. We looked at this briefly. It allows taxpayers to defer the recognition of certain types of realized income for installment sales, like-kind exchanges, involuntary conversions, and contributions to non-Roth qualified retirement accounts. We'll talk about a few of those in later chapters. All right, so that's it for Chapter 5.